Hello to all my fellow investors and traders out there. This is Lee Lowell, smartoptionseller.com. It is Friday evening, April 24th, after market close. Thought I'd put out a quick little video, show you what's been going on. This has become a weekly thing for us, so I hope these tutorials are a little helpful to you and a bit educational, and that I'm helping you out to become a better trader. So let's go over what we've seen in the market this week. I've got my typical chart up here, daily chart of the SPY, which is the proxy for the S&P 500. It's the exchange traded fund called the SPY or the SPY. What have we seen this week? Well, the last 2 weeks, the market's been coiling itself into a pretty tight range right here. And that's because we've had the ultimate down move and then this 50% up move, right? We had this huge bounce, and I've been calling it the V-shaped bounce. People call it the V-shaped bounce because that's what you get. Run a really hard down move and then a quick up move called V-shaped bounce. And previous charts I've been showing, previous videos I've been making, I've been telling you that this 50-day moving average line right here was going to be a little bit of a resistance to the market, and that's exactly what's really been happening over the last 2 weeks. And what's happening right now, it's just coiling itself into this what's called a triangle pattern, coiling pattern, that once it breaks out, it's going to break out hard in either direction. We just don't know what that direction is going to be at the moment. And for any of you Fibonacci fans out there, Fibonacci is a type of chart analysis. In the Fibonacci world, the 50% retracement is a huge deal to Fibonacci people. And what do I mean by that? Well, you take the last major high, compare it to the last major low. You take the distance in between, which we got 340 down to 220. That's 120 points from top to bottom. 50% of that is 60 points. So that would mean from the bottom, you're going to rally 60 points, or from the top, you're going to drop 60 points. And where do we go? Right in between. 220 to 340, 60 points, right at the 280 level. And that's exactly where the market's been coiling for the last 2 weeks, right around that 280 level. We've got a massive amount of earnings coming out next week. All the big players, Google, Apple, Amazon, all the big players. And that's definitely going to move the market out of this compressed range. So right now, it's gotten real quiet. Next week, probably by next Friday, after all those big earnings coming out, you're going to see the market either move up pretty good or come down again. It all depends on how the numbers look. And so how can we tell what to do with those numbers? Well, some people like to try to make an options play on the breakout move. And typically the best way to do that is to buy some at-the-money straddles or strangles, which pretty much you can buy a call option and a put option at the same time. So you're taking advantage of a big market move in either direction. You buy a call, if the market goes up, you make money. And you buy the put at the same time, so if the market drops, you make money as well. But the thing is, the market has to move really big for you in order to profit on buying a straddle or a strangle. And right now, volatility is still very high. And let's take a quick look at the VIX. I brought this chart up before. The VIX is the volatility indicator, the fear indicator. It shows you how erratic the market has been over the past. And as we know, the VIX is typically pretty low. It means that there's not a lot of erraticness in the market until we got the major down move. The VIX moves inverse to the market. And third week of February, when everything started falling out of bed, volatility started going up, hit these all-time highs. But at the same time, I've shown you that volatility spikes very quickly, and then it starts to come down very quickly. We go back to the monthly charts of the VIX. You can see all these spikes, right? All these spikes. They don't last very long. So if you want to take advantage of volatility, you can make trades in what's called the VXX. And I've shown you the VXX before. You can't really trade the VIX itself, but the VXX you can trade. And I've been selling bearish call spreads on the VXX, taking advantage of this down move. So you can certainly trade volatility. I've written about that before. I've made some videos about that before. But if you want to take a stab at the actual market itself, which would mean that you possibly want to trade some straddles or strangles on the SPY, Volatility is high though, so buying options when volatility is high is not really the best thing to do. Let me show you what I mean by that. Let's pull up some options chains of the SPY. This is for May 15th expiration, so 21 days from now. You typically look at the at-the-money options. What are the at-the-money options? Well, the at-the-money options are the strike price, whose strike price is pretty much the same as the stock price. So the SPY last traded around 283 and change. So you look at the 283 strike right here. If you want to buy both the call and the puts, you look at buying the 283 puts and the 283 calls. You add them together and you're looking at like, I don't know, $16.75. So if you buy that straddle, the SPY has to move at least $17 in either direction for you to make money on that. That's a pretty large move. And how do we tell if that's a large move for the SPY? Well, what we can do is go back to my iVolatility, iVolatility.com, great website for your volatility information. And what you see in front of you is an options calculator. You got the inputs on the left and you got the call and put values on the right. So what we want to do is change the expiration here to those May 15 expiration. Volatility about almost 31% for the SPY for a 1 month option. That's very high. And as we know, we've seen the VIX chart. So volatility is up. And what do the options look like? Well, we looked at those 283. We're looking at the 283 strike, call and put options, just that I showed you in the option chain. The calls are $8 and change, and same with the puts, $8 and change. So you're looking at roughly $16.75 for that straddle, just like I showed you in the option chain. Now, on a typical, when things aren't as hectic, the volatility in the SPY is probably about 15%, maybe even lower. Let's see how the option prices change. Keep your eye right here on the call and put values. When I hit this calculate button, you can see the values get halved, lose 50% of their value because we took the volatility down 50%. And that's what it does to the option. So if you were to buy this straddle now, when things are not as erratic, it would only cost you about $8 per contract. Whereas when volatility is at 30%, 30.93 I think it was, that pumps up the option prices. So you're paying double right now for that straddle. And that means the SPY has to move really, really far in either direction. So as an option buyer, you typically want to buy when volatility is cheap. As an option seller, you like when things are on the high side. So these are more, this is a better environment for option sellers, but you got to be real careful as an option seller. If you sell that straddle, you got unlimited risk in either direction. And with the big players, earnings coming up this week, the market can move really far against you, so you got to be careful. How do we know? Let's take a look at, we've got the earnings I've been telling you about. On Tuesday, April 28th, we got big hitters. We got Advanced Micro Devices, Google, Caterpillar, Starbucks, Merck. Let's see, on Wednesday, April 29th, you got Microsoft, Facebook, Tesla, MasterCard. These are stocks that can move real big. And if they move big after their earnings, it's going to pull the market with them. On Thursday, April 30th, Apple, Amazon, Twitter, Visa. This is a big day. So you got to be careful. McDonald's, going back to the chart of the SPY, we're coiling up pretty good here. That moves, once it blasts out of this triangle pattern, it's going to move pretty big in either direction. We just don't know which way that is yet. So, if you're an option buyer and you want to take a stab at that, more power to you. You just know that you're going to be buying inflated options. So that means the market really has to move in your favor. If you're an option seller, you're going to be taking advantage of the high volatility. But as I said, the market could move big, so you got to be careful. For me personally, I'm staying out of it. I don't want to get caught in either direction. I'm just going to wait it out and see what happens. I've been saying that it's hard for me to believe that this market can sustain this up move only because of all of the unemployment numbers out there, especially in the United States. With 26 million Americans filing for unemployment insurance, it's hard for me to believe that these companies are going to produce really good earnings. The U.S. consumer makes up 65 to 70% of the U.S. GDP. The consumers is what drives the economy, and if no one has a job, no one's making money, no one's buying products. So it's hard to believe that earnings are going to be good enough to sustain this rally. In my gut, I think the market is going to come back down again towards the lows. But you don't want to argue with the market because it'll rip you apart. So I'm on the sidelines for right now, and let's see what happens after this big week of earnings. That's all for me today. I hope everyone has a great weekend, and I'll check in back with you next week. This is Lee Lowell signing off.